Welcome back to SilverDispatch. I'm OG Peter, and before we go anywhere today, before I even give you context, I need you to look at these numbers with me. Silver, 86.80 per ounce at session open. Gold, 4,680. West Texas Intermediate crude above $101. Brent crude above under 5. The 10-year U.S. Treasury yield, 4.49%, the highest it has printed in 10 months. The 30-year Treasury crossed 5%. The U.S. dollar index hovering near 98.40. You are not looking at projections. You are not reading a forecast generated by someone running optimistic assumptions in a conference room. These are live market readings. Prices formed in real time by real capital reacting to real conditions. And here's where this gets serious. On the morning of May 13, 2026, at precisely 8:30 Eastern, the U.S. Bureau of Labor Statistics released the April Producer Price Index. The headline number came in at 1.4% month over month. The professional consensus, the aggregate estimate of the most resourced analytical minds in global finance, was 0.4%. That is not a forecasting error. A miss is 1 or 2/10 of a point. What the market received Wednesday morning was a print running at roughly 3.5 times what the consensus had projected. On an annualized basis, producer prices rose 6.0%, the hottest reading since December of 2022. Core PPI, which excludes food and energy, rose 1.0% month over month against a consensus of 0.3%. The annual core reading settled at 5.2%. But there's a catch. The release also documented that nearly 60% of April's final demand price increase was driven by a 1.2% surge in services alone. Stage 1 intermediate demand, meaning costs still traveling through the pipeline toward your wallet, rose 2.7% for the month and 8.9% year over year. That is the largest 12-month increase recorded since October of 2022. This came one session after the April Consumer Price Index confirmed headline inflation at 3.8% year-on-year with core CPI at 2.8%, both readings above consensus. Read them together, and the conclusion is not complicated. Inflation is not retreating at the wholesale level. It is building. The federal funds futures market understood this immediately. Within 90 minutes of the 8:30 release, the implied probability of a Federal Reserve rate hike by December moved from approximately 16% to above 35%. Zero rate cuts are now priced for the full calendar year. The market has spoken. Now the question is, what does it mean for silver specifically? And that is where this analysis gets genuinely complicated. Here's the part of this story that most financial coverage glosses over, and it deserves your full attention. Silver is not supposed to be doing what it is doing right now. In a rising yield environment, the opportunity cost of holding a non-yielding asset climbs. In a strengthening dollar environment, dollar-denominated commodities face natural headwinds from international buyers, priced out at the margin. These are not opinions. These are the foundational mechanics that every commodity analyst applies without debate. And yet, silver has risen more than 172% over the trailing 12 months. The gold-to-silver ratio, that long-standing measure of relative monetary stress between the two metals, currently sits near 55. 3 weeks ago, following the 90-day tariff pause between Washington and Beijing, it compressed from a peak reading of 62. What followed was a demonstration of silver's industrial monetary duality, the kind of rapid upside sensitivity that its demand structure has always carried as potential, but rarely delivered in both directions simultaneously. However, this is where the structural picture becomes impossible to dismiss, regardless of where you stand. On the afternoon of May 13th, the U.S. Senate confirmed Kevin Warsh as the 11th chair of the modern Federal Reserve by a vote of 54 to 45. That is the narrowest confirmation margin in the recorded history of the institution. One Democrat crossed the aisle. Every other vote broke along partisan lines. Understand what that margin communicates. The Federal Reserve has spent decades cultivating an identity as a technocratic institution, insulated from partisan mechanics, operating above electoral cycles. A 54 to 45 confirmation vote at the precise moment inflation is running at its hottest combined reading in nearly 4 years is not a procedural footnote. It is a declaration that institutional confidence in this appointment is genuinely divided. Warsh's documented record is clear. During his prior governorship from 2006 to 2011, he publicly argued that the Fed's quantitative easing program overreached when the balance sheet crossed $4 trillion. He has called in his own published work for fundamental regime change at the central bank. This is the man now walking into a June 16th and 17th FOMC meeting carrying the hottest inflation tape in years. And there is one more layer. Jerome Powell, the outgoing chair, has confirmed he will remain on the Federal Reserve Board of Governors through January 2028. The first departing chair to return to the board in nearly 8 decades. The modern era has no precedent for a two-chair Fed dynamic. No one can say with certainty what it produces in practice because it has not occurred within living professional memory. Institutional ambiguity, a documented policy hawk, and a PPI print 3 times above consensus. These are arriving together, not separately, together. Let me set 3 things in front of you simultaneously, because the confluence is what matters here. On May 13, 2026, President Trump landed in Beijing for the first U.S. presidential state visit to China in nearly 9 years. The formal agenda, per published briefings from the Council on Foreign Relations, the Center for Strategic and International Studies, and Brookings, covers trade architecture, rare earth export controls, Taiwan, the Iran conflict, and artificial intelligence. Jensen Huang of NVIDIA is part of the delegation. China does not arrive at this meeting from a position of weakness. It currently holds leverage on rare earth and magnet exports. On physical silver inventory, Chinese importers are paying premiums of 12 to 13% above Western spot, with Shanghai silver trading above $90 per ounce locally. On semiconductor supply chains through its Nexperia position, and on Iran mediation. The United States walks into that room carrying the hottest combined inflation tape in nearly 4 years, a newly installed hawkish Fed chair, and a Strait of Hormuz that has been effectively closed to commercial shipping for 75 consecutive days. This is where it gets interesting. The Strait of Hormuz, the passage through which roughly 20% of global oil supply normally flows, remains under dual pressure from American and Iranian naval forces. A conditional ceasefire technically exists. However, per the House of Commons Library briefing of May 13th, almost no commercial shipping has transited the strait. The International Energy Agency's most recent published report states directly that even if the conflict ends sooner than expected, global oil markets could remain severely undersupplied through October. Former senior energy advisor Amos Hochstein described the current state as a frozen conflict. Former NATO Supreme Allied Commander Admiral James Stavridis estimated that reopening the strait by force, the most likely resolution scenario, would require significant naval resources, ground presence, and approximately $1 billion per week in operational costs. Saudi Aramco's chief executive has stated publicly that the market is losing approximately 100 million barrels of weekly supply. Now ask yourself this. If oil is the single most pervasive input cost across manufacturing, transportation, agriculture, and services, and it is, and if the April PPI print of 1.4% was already partially energy-driven, and the energy disruption that produced that shock has not been removed but has persisted into May, what does the May producer price reading look like when it arrives? The April number was a shock at 1.4%. The underlying pressure has not eased. It has compounded. These are not doomsday projections. These are sequenced facts drawn from published institutional sources, priced into live markets right now. I want to give you both sides of this completely. That is the SilverDispatch standard, and I'm not breaking it today. But first, the physical supply picture, because it is extraordinary. The COMEX silver market is in published backwardation. Spot price sits above front-month futures. In commodity markets, backwardation is a textbook signal. Immediate physical demand is pressing harder against deliverable supply than the forward curve anticipated. Registered silver on the COMEX, the inventory actually available for futures delivery, sits at approximately 76.8 million ounces, against open interest of approximately 575 million ounces. That is a delivery coverage ratio of roughly 13.4%. Approximately 7.5 paper claims exist for every single deliverable physical ounce in the registered system. The Silver Institute's World Silver Survey, 2026, published April 15th, projects a 46.3 million ounce supply deficit for the current year, the 6th consecutive annual deficit. Cumulative above-ground stock drawdown since 2021 has now formally reached 762.1 million ounces. The Institute used language that rarely appears in commodity survey publications, stating directly that silver has entered an era of reduced stocks. Chinese silver imports in early 2026 reached their highest level in 8 years. SPDR Physical Silver Trust added 6.1 million ounces in Q1 alone. Russia has formally incorporated silver into its sovereign reserve program. And Bank of America's published upper bound 2026 silver price target sits near $39 per ounce, approximately 250% below where silver is actually trading this morning. However, and this is important, the bearish case is real and it belongs on this table. Silver at 86.80 remains roughly 28% below its all-time intraday high of 121.67 printed January 29th of this year. The Reuters full-year consensus average sits near $79.50. JP Morgan's full-year target is approximately $81. The 10-year Treasury at 4.49% and the 30-year above 5% represent genuine compounding opportunity cost against a zero-yield metal. India, the world's second-largest physical bullion consumer, just doubled its import tariff on gold and silver from 6% to 15%, removing that demand pool from full purchasing velocity in the near term. The iShares Silver Trust still carries 3-month net outflows of $2.82 billion, materially larger than this week's positive 5-day inflow. These counterforces are legitimate. Intellectual honesty requires stating them directly. But here is where OG Peter lands as of May 14, 2026. The structural variables assembling right now. A hawkish Fed chair confirmed on the narrowest vote in institutional history. A Hormuz closure priced to persist through October. A Beijing summit where China holds multiple points of simultaneous leverage. A COMEX registered inventory running at 13.4% delivery coverage. 6 consecutive years of supply deficits, and a major bank's upper bound forecast sitting 250% below spot. These variables were not inputs in the models that produced January's price targets. The data does not negotiate. It does not adjust itself to be more convenient. It simply accumulates. Pay attention to what it is telling you. Reason from the evidence in front of you, not from the narrative you arrived with. And as always on SilverDispatch, this is education and analysis, not personal financial advice. Your capital, your risk tolerance, your decision. I'm OG Peter. Drop your read in the comments. What fracture has your attention right now? What are you watching that this analysis did not cover? The best thinking on this channel has always started in that comment section. See you there.